Hi, I'm Olivia Albrecht, and I'm joined by my colleagues Scott Mather and Joachim Fels. We are here to discuss our outlook for 2018 and what it means for investors. Feels like we're starting off the year in good stead. We've got the tailwind of 2017's synchronized global growth story. We're showing here PMIs for key regions of the world, and they're all in expansionary territory. So is this the full picture for 2018, or is there something more?
Well, Olivia, the stars are really aligned for a continuation of the Goldilocks environment that we saw last year, above trend global growth and low but gently rising inflation. And I think there are a few reasons for that. First of all, as you've mentioned, we have tailwinds from the very strong momentum. So the ramp going into the new year, into 2018, is very strong. Second of all, financial conditions are very easy and have eased further because risk assets continue to rally. The dollar has weakened, interest rates have stayed relatively low. So there's good support from financial conditions. And then the third reason is that China keeps suppressing its domestic economic and financial volatility, and other emerging market countries are also seeing an improvement in their economic fundamentals. So overall, it looks like a good year. But here's the catch. The problem is that this Goldilocks extended scenario seems to be pretty much baked into the consensus and into asset prices. And our concern is that we may see a peak for growth this year. And we think that it's important to focus on some of the risks that are out there for 2018 and beyond. First of all, the US is now depleting its fiscal toolkit. So we're getting tax cuts, we're getting higher fiscal spending. That's not exactly what we need at this stage of the cycle. It would be better to keep the powder dry for the next downturn. Second risk is an inflation overshoot. You know, we have the fiscal stimulus, we have globally synchronized growth, we have rising commodity prices, we have a weaker dollar, so there is a risk that inflation overshoots for the first time in this cycle. And then the third risk I would highlight is the risk of monetary overkill, because all major central banks are now heading towards the exit, and it may well be that markets and the economy have become addicted to low interest rates.
That's perfect. We're showing here how markets have kind of continued to romance the positive stories and the positive economic fundamentals. We see here on the left-hand chart, U.S. equities continuing to soar. On the right-hand side of this slide, we see credit spreads continue to tighten here. So what is the market telling us, and are we poised for a correction in the year ahead?
Well, probably the simplest explanation is that it appears financial markets are putting a very, very low probability on any sort of slowdown or change in economic momentum. They're also putting a very, very low probability on a normal level of surprise, if you will. And it's understandable in the context of how long this expansion has been and how lowly volatile it's been. And of course, to the point that Joachim made, now that we're on this synchronized phase of global expansion, is sort of, people are extrapolating upon that. And it seems to be priced into financial markets. Our concern is that any sort of growth slowdown, any sort of surprise, which is normal, that you would expect in a cycle, is likely to have a bigger impact given the level of valuations today in financial markets. And we sort of have a calendared event, if you will, which touches on another point you mentioned, which is the shift from nonstop monetary easing and balance sheet expansion by global central banks. That episode is really drawing to a close this year, where all countries begin that normalization phase in earnest. And it's hard to quantify what the effects will be on the market, but we anticipate it will result in more volatility.